Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest from ChargePoint. Get ready for a roller coaster because their recent financial report is like a charging cable with a few exposed wires. Things could get shocking. We'll break down the key numbers, the risks, and what it all means for this EV charging giant. First off, ChargePoint sees itself as a key player in the shift to electric vehicles, powering over 342,000 charging ports. They aim to be the go-to for charging hardware, software, and services, serving everyone from businesses to homeowners. According to them, passenger EV sales are expected to jump way up by 2040. To make that happen, a ton of investment is going to be required for EV infrastructure across North America and Europe, potentially hitting almost $500 billion by 2040. Let's talk about their offerings. ChargePoint makes money selling network charging systems, those stations you see in parking lots. They also sell software subscriptions. Think of it as the operating system for those chargers, and extended warranties, which they call Assure. They have both AC, which is your standard home or workplace charger, and DC fast chargers, which are for those quick top-ups on the go. ChargePoint is focusing on the importance of its ChargePoint platform and how it can help manage complexity. This includes things like adjusting charging rates to avoid peak electricity charges, reserving charging for private fleets at night, and integrating with telematics software to improve fleet reliability. They also claim the software will let stations share circuits, allowing some more interesting options. They enable a lot of features to fleet operators using the ChargePoint platform. The goal is to reduce those fleet operating expenses. They also license its EMSP service to e-mobility service providers in a combination of per vehicle, per EV driver, or per transaction fee models. This allows e-mobility service providers to build and publish mobile and in-vehicle applications for EV charging. To engage with those EV drivers, ChargePoint has its own mobile app. It lets drivers find stations, see pricing, and make payments. The company believes that the app creates driver satisfaction and will ultimately result in greater purchases of their equipment and platform. To sell their products, ChargePoint uses a two-tiered indirect model, selling to distributors who then sell to resellers, who then sell to end users. They expect to continue using this model to grow internationally. They want to keep ahead through investing in research and development. But unlike some of their competitors who own and operate charging stations, ChargePoint focuses on having others manage those charging networks. Let's dive into competition. The market is definitely getting crowded with competition from hardware manufacturers like ABB Siemens and Tesla. On the software side, they have companies like EV Connect and Monta Apps. Alright, now for the part we all care about, the risks, and there are plenty. One big one is their history of losses and negative cash flow. The company says they expect significant expenses and continuing losses for the near term. They have to comply with the listing standards of the New York Stock Exchange. Failing to do so, they could be delisted, which could affect their stock price. Another significant risk is the continued adoption of EVs for passenger and fleet applications. If that doesn't grow as expected, ChargePoint will struggle. They've also flagged data security breaches as a risk, as well as identifying material weaknesses in internal controls. A big risk for ChargePoint is their indebtedness. In April 2022, they issued convertible notes, and they have a revolving credit facility that imposes restrictions on their business and operations. This debt could limit their business flexibility and access to capital. Also, keep in mind what the document states. Forward-looking statements reflect current views about ChargePoint's plans, strategies, and prospects, which are based on information available as of the date of this annual report. Now let's get to the juicy numbers. For the fiscal year ended in January, ChargePoint reported a net loss of $277.47. It was $7 Tontaru, $47, $67, $47.76 million in the previous year. It also mentions that as of July of last year, the aggregate market value of their voting stock held by non-affiliates was around ever $9 billion. They are incorporating parts of their proxy statement related to the 2025 annual meeting of shareholders into part 3 of this report. Let's navigate the meat of the financials. This next section gives management's view of the business. It mentions that the strategies to continue to scale include innovative offerings. The most important thing to scale is research and development. Interestingly, almost all of ChargePoint's commercial and fleet networked charging systems are installed and utilized outdoors. Therefore, their financials are heavily dependent on construction, which takes a hit during the winter. They determine affiliate status, but only for the filing It should be noted that the market values of executives, directors, and affiliates are not part of the market cap figure they quoted. For growth, ChargePoint is focusing on increasing research and development and growing their customer base, as well as accelerating their ChargePoint platform solutions. Their three key verticals are commercial, fleet, and residential. Commercial are businesses and dedicated ChargePoint operators. Fleet customers operate vehicle fleets, and residential are single-family residences. With ChargePoint, because it rarely owns and operates charging infrastructure, it is able to allocate capital strategically towards ChargePoint's initiatives in new product research and development and public policy. Because ChargePoint predominantly does not own and operate charging stations, ChargePoint does not believe it competes directly with ChargePoint operators. ChargePoint also has a global supply chain management team that works proactively with piece part and final assembly supply partners. That supply management team readies factories for new products, puts in place and monitors quality control points, plans ongoing production, issues purchase orders, and coordinates deliveries to distribution hubs that ChargePoint manages in North America and Europe. Okay, let's check out these risks that ChargePoint says is facing them. One of the big risk factor is that they have identified material weaknesses in its internal control over financial reporting, and that they are unable to accurately anticipate market demand for its products. Another major risk, ChargePoint relies on a third-party channel partner network of distributors and resellers to generate a substantial amount of its revenue. There are future sales of ChargePoint's common stock in the public market that could reduce their stock price. Tariffs and government regulations could also pose some problems to their business, as well as trade restrictions and increased tariffs. Finally, the report indicates that they have filed a report on and attestation to its management's assessment of the effectiveness of its internal control over financial reporting. ChargePoint's common stock is traded under the symbol CHPT and is listed on the New York Stock Exchange on West C. As of March 19, 2025, there were approximately 335 holders of record of ChargePoint's common stock. They included a performance stock graph comparing themselves to S&P Midcap 500 Index, the S&P Application Software Index, and the S&P 500 Technology, Hardware, Storage, and Peripherals Index. As of this January, ChargePoint had cash and cash equivalents and restricted cash totaling $225 million. The auditors are of the opinion that ChargePoint maintained, in all material respects, effective internal control over financial reporting as of this January. Now onto the financial tables. Their cash and cash equivalents decreased by over $100 million, and their accounts receivable also took a hit, going from $124 million to $95 million. However, inventories increased on-sitely to section we see that accounts payable decreased, while total liabilities increased only slightly. Looking at the consolidated statements of comprehensive loss, the company saw a loss of over $277 million with nearly $10 million in other comprehensive loss, most from foreign currency. The net loss per share was 0.64 fern for both basic and diluted. This means there is little to no option value in the company. Taking a glance at the consolidated statements of operations, we see a breakdown in revenue. In thousands of dollars, network charging systems brought in 2,124. Subscriptions increased up to 144,325, and other revenue also increased up to 37,956. The network charging system's cost of revenue was $23,351. Subscriptions were $71,218. Other revenue was $21,833. Ultimately, this means that their gross profit was at $106,881, which increased significantly compared to last year. At Twisted, there were $141 million, and the total operating expenses reached over $352 million. This resulted in loss from operations of $252 million. This resulted in loss from operations of $252,999. The benefit from taxes was $4,372, with the final net loss reaching $27,066. This is the most important indicator to look at, over $146 million in cash used from operating activities. Compare that to their total cash and cash equivalents and restricted cash you get in 1.6 years left at this rate, which by the way stands at $224,971. And if you expect dividends anytime soon, you'll be disappointed. ChargePoint has never paid dividends and does not anticipate paying dividends in the foreseeable future. Regarding the company structure, that section is incorporated into the definitive proxy statement. The management team may not successfully or effectively conduct the management of a public company. For example, their current chief executive officer and chief financial officer have limited experience in the management of a publicly traded company. Lastly, as with all SEC filings, I recommend checking out the exhibits if you are interested in finding something deeper. Now, looking at these numbers more broadly, ChargePoint is in a tough spot. While they're talking a big game about the future of EV charging, the financials tell a different story. Their revenue from network charging systems is down almost 35%, which is a huge problem, and their profitability is entirely based on cost-cutting efforts and nothing else. The expenses had no problems exceeding revenue until the reduction efforts kicked in, and despite those cost-cutting efforts, their cash will still only last so long. With no profit in sight, it is questionable if they can keep selling more shares without facing major problems and further dilution, as this is becoming a self-fulfilling prophecy. So if EV adoption stalls or the market shifts, ChargePoint could be in serious trouble. ChargePoint is a high risk, high reward. If it can pivot, innovate, and secure funding in time, its brand name can get them really far. However, their finances are a cause for concern for any investor. Egg hints for watching. If you enjoyed, please subscribe, like, and comment.